Alrighty, so this is video number 2 on the series that I'm working on. We're talking about stock market mechanics and terms that I think you need to know moving forward for the rest of the series, and we'll just jump right into this. So what is the stock market as a whole? In essence, the stock market is just a relationship between buyers and sellers of an asset. So I'm trading shares, which is going to be fractional ownership of a company. It's the exact same if I was trading like crypto or something. It's still the asset, and it's just the relationship between buyers and sellers that makes this happen. So in practice, this is a very cyclical cycle where buyers need sellers and sellers need buyers. If I am trying to buy shares, there has to be a seller that is trying to sell that to me. And if I'm trying to sell shares, there has to be somebody who's willing to buy the shares that I'm selling. So for orders, if I was trying to sell Apple for $100, there has to be an identical buy order to buy Apple for $100, and this is going to result in one executed order. And the entire market is made up of these executed orders just over and over and over again. So if you were to look at something like an order book, you have buyers here on the left side and sellers here on the right side, and it moves in this sort of V shape where this middle price is the current agreed upon price or the equilibrium, and this is where the bulk of orders are going through and trading at, and this is the price that you're going to see. But the orders that are on the extreme sides of this are going to be the direction that price is trying to push to, but it's having difficulty because there's this equilibrium and this balance that's happening. So you can visualize this a couple different ways. This is order flow visualization, where you can see that there's more buying down at the bottom of this, and then there's less selling up at the top. I would never really use anything like this, but it's out there and you can use it. This is a trading view indicator that you could use. And then for level 2 market data, this is what you're going to have to look at if you want to see these orders start to go through. So MMID just stands for market maker ID. This is the routing system that your order is taking. It's not really something that you need to know about, but that's what it is. The bid is the buyers. So this is going to be the highest price that a buyer is willing to pay for shares. And then the size is obviously the share amount. And then the ask is sellers, and this is the lowest price that a seller is willing to sell their shares for. And there will always be a little bit of an imbalance here, and that's sort of what teeter-totters price around to fight for a price. So this is what level 2 looks like in Active Trader Pro. Over here on the right side, this is the time in sales or the tape. So all of the moving lines and the moving orders that you see on the tape here, these are live executed orders. And then the orders here on the left side are just stacked orders that are waiting to be executed. So what pushes price and what really moves all stock in general is going to be the stacking of orders on the bid or buyers, and then the stacking of orders on the ask or sellers. And you can see how this sort of pushes price in a direction, and that's what makes price sort of ebb and flow towards a direction. And so as far as order types go, there's 4 main order types. You have market, limit, stop, and conditional orders. I really only use limit and stop orders. Market orders and conditional orders sort of have faults, and I'll talk about that here in a minute. But for market orders, this is going to be buying and selling at the most recent and available price. And then limit is going to be buying and selling above or under a set price. Stop is going to be buying and selling if price reaches a set price, and then conditional is just any combination of these. So as far as order tickets go, if you were to place a trade, this is sort of vaguely the screen that you're going to be looking at. So it'll be the symbol that you're trying to trade, if you're buying or selling, the quantity or the number of shares, and then the order type, and then we'll go over everything else. But so as far as order type goes, these are all of the order types. Once again, market, limit, stop. Stop limit is just a combination of a stop and a limit order. And then trailing just means so a trailing stop is going to be if I wanted to sell a stock if it fell $5. That's what I would use that for. If I wanted to sell a stock if it dropped 5%, that's what I would use that for. And then TIF stands for time in force, and this is the duration of an order. So if I had a time in force of day, that means that my order is only valid till the end of the session, and then it doesn't exist the next session. If I had a time in force of good till canceled, it means that my order stays going into the next session and stays until I cancel that order. Fill or kill just means that if I was trying to buy 100 shares, I want all of my shares filled or none of my shares filled. And then immediate or cancel is when I am trying to buy shares, I want to be filled immediately or cancel the entire order. And then on the open is what it sounds like. It's going to execute an order right at the open of the market. And so these are two very specific trade tickets. On the middle is a stop order ticket, and then a limit order ticket. So you can see for stop order, it's not filled, but you can enter the stop price, and then for a limit, you can enter the limit price, and then for both of them you'll have a time and force and a an action here. So I'll give an example of a buy stop. A buy stop is going to be if I was looking at this chart and I wanted to buy here at this green line price level. If I said that as soon as price crosses this green line, I want to be in immediately, I would place a buy stop order and I would place that order right at that green line level. And then as soon as price moves through that, I get filled right as it moves through that. And that's where my shares are going to be executed to. And then the same thing goes for a sell stop. This is sort of where you get the term stop loss from. So if I was holding this stock and said that I didn't want to hold shares any lower than this red line, I would place a sell stop at that red line. And then as soon as price crossed under that red line, I would get filled right there and I would be out and I would sell my shares. So a sell limit is going to be I am only going to sell shares if it is at this price or above. So if price reaches this price here, I want it to sell and it'll sell all the way up in here. So as soon as price moves in here, this is good for if you thought that price was going to wick up into it and you really just want to get out at that price regardless. So it would sell immediately, and then even if we flush back down, I still would have gotten filled up in here. And then a buy limit is going to be that means that it is going to buy anything. It's going to buy shares at this line or under. So if I had a buy limit up here at this green line, and then I executed the order here, I will never pay for shares up in here. I would never get filled up above that green line. This is the absolute limit of the price and the dollar amount that I'm willing to pay for my shares. And so that's orders. And then what makes up the market? Who is trading in the market? So from Investopedia, they estimate that 80% of the S&P 500 total market cap is comprised of institutional investing accounts. So that means that the big boys and girls like Goldman Sachs, Citadel Securities, Vanguard, Fidelity, BlackRock, etc. These are really what's making up almost the entirety of the market. They have such access to capital and they use so much money in their trades that really the only certifiable way to identify them is through huge volume on the charts. You could look up SEC filings and see exactly what they buy, but for the most part, that's going to be delayed info and it's not going to be as applicable as trying to search for and get really good at recognizing these big accumulation signs for these big institutions. And so we'll start with general market terms now. The first one that I want to talk about is ETFs and indexes. So an ETF is going to be one single instrument that holds multiple assets, and then an index is going to be one single instrument that tracks a bunch of assets. So the S&P 500 is an index that consists and tracks the 500 largest publicly traded U.S. companies, and this is weighted by market cap. And we'll go over what market cap is a little bit later, but that's what the S&P 500 is. And then QQQ is an ETF that consists of the 100 largest non-financial US companies. So you can think of ETFs as more of a basket of stocks or more of a portfolio that you're investing in. And then the S&P 500 or general indexes is more just tracking the market. So some common indexes and ETFs would be the Dow Jones, the Russell 2000, the Nasdaq. These are basically the names that you think of when you think of investing when you were younger, or this is what the majority of people are invested into because it's much less risky and you're sort of betting on the market going up as a whole, which is almost always true. And you can see some of the top holdings here. So that's top holdings for SPY, QQQ, and then XLF is the financial sector of SPY. And so continuing with ETFs and indexes, for the most part, all indexes and large scale ETFs trend together with similar points of up and down trends because they're so large and they hold a lot of the same stocks. If you wanted to look at this, the top holdings of SPY and QQQ are almost the same thing. But because they move together so much, ETFs and indexes can be used to track the market's general health or the market's general direction. So an example of this would be the pink line here is SPY, and the chart here is GEV, which is just a random electrical company. You can see how well these are correlated. So when SPY goes on these huge runs up, GEV does the exact same thing. When SPY pulls back really sharply, GEV does the same thing and then flushes back up. So a good way to recognize what strong stocks are and what non-strong stocks are is when SPY makes these pullbacks and it goes down, the intensity of the pullback, if it's less severe on a single stock, then you know that that stock is displaying relative strength. Because if SPY is the top 500 companies and SPY is going down, that means that the largest companies are falling and that the general market is sort of going down. And if a single stock is able to hold that pressure and then move up eventually, it means that it's displaying a lot of strength and it's basically ready to go. Is a good way to think about it. And so, moving on with market terms, company fundamentals is going to be earnings, sales, and revenue. So typically companies report the data on their product sales, revenue earned, and various other metrics every quarter of the year. So throughout a trading year, you'll need to be aware of quarter one, quarter two, quarter three, and Q4 earnings seasons, and then be able to react accordingly and sort of plan around those. And so, as far as earnings seasons go, analysts throughout the year will create estimates for a company's reported metrics before they come out. So that means that if a company beats the estimates, or analysts and investors are impressed with the data, there's a chance that the stock price will rise. And then the inverse is true. So if a company misses their earnings estimates or what investors are looking for, the stock price will can fall as large institutions may sell their positions or just lose faith as the company declines in general. But this gets sort of sticky as we go on, and you'll see that. Some examples of this would be QBTS had some really good earnings in Q1 of 2025, which resulted in the stock making, it moved 51% on the day of earnings. And then to this day, it's trading at 161% above the day of earnings, which is really impressive. And then on the flip side of this, you have SMR, who at the end of 2023 had really bad earnings, and it resulted in a 50% drop in share price over the next 2 weeks, which is really bad. And then this is sort of where it gets sticky because earlier this year, Tesla posted some shockingly bad earnings and revenue, and then the stock price still shot up and rose over 50% over the next month. And this was due to various extenuating circumstances, but this sort of shows that earnings is not everything. You could post really good earnings and it would go down, or you could post really bad earnings and it could go up. So you can see this with Nvidia here. At the very beginning of this year, Nvidia beat their quarter one earnings, but investors were underwhelmed, and the price fell 38% over the next month, even though they beat their estimates. So, uh, in general, earnings are something that you can't really bank on. It seems really simple in concept, but it's something that's a little bit more nuanced and needs a little bit more practice and just sort of experience in the market to learn how to navigate. And it's still something that is confusing to me and doesn't really make me feel exactly comfortable. And what a lot of people do is they'll sell a lot of their position, or they'll really trim their position down when they're going into earnings, because the you never really know what's going to happen there. And so, moving on with market terms, the other stuff that I think is important is just going to be other fundamental data. So this is going to be stuff like debt to income ratio and earnings to share price ratio and a couple others. But investors and analysts use this to create price targets. So price targets are just based off of many different data points. But so this is going to be like if a stock is currently trading at $10 and a large institution like Vanguard says that they think the price could go up to $20 in the near future, Vanguard would have set a price target for $20, and this could cause retail traders or other institutions possibly to look more into buying the stock because there's an increased demand as it seems that there's a higher upside potential to the stock. And then so the last thing in this is going to be sectors, industries, and groups. So stocks as a whole are categorized into groups by sector and industry, and this is based on the field that they provide services or goods to. So examples of this could be electrical components, rare metals, quantum computing, nuclear power, and really a whole bunch of other ones. But sectors and industries can be used to identify what areas of the market are performing really well relative to other industries and sectors. So you can get this sort of top-down approach when you're selecting stocks and sort of figuring out what areas of the market are hot. Um, and so, still going with this, these are general stock terms. So, this is a little bit more focused on individual stocks. So, market cap, the formula for market cap is going to be the total number of available shares. So, just all of the tradable shares for a company times the current price of a stock. This is going to be the market cap. And this is typically split between small cap, mid cap, and large cap. And that's just sort of a way to categorize the size of a company. And then volume is the number of shares traded over an interval of time. So I think that the most applicable version of this is going to be the 20-day average daily volume. So this is the number of shares a company trades in a single day, and then it averages that over the last 20 days. So it can sort of give you a good average price or average volume that a stock trades so you can see when it's over or above that line. And then ADR is a little bit similar. The range, so ADR is the range from the low of day to the high of day that a stock makes. And then, so once again, this is really only applicable for the average 20 or the 20-day average ADR is the most applicable because you can see sort of how quickly a stock moves. This is sort of a good gauge for volatility or how much upside or downside move you can be expecting from a stock. So the average ADR percentage of SPY, for example, is it ebbs and flows, but it's around 1%. And then the stocks that I trade are going to be, I'm looking for stocks that are shooting for that 5% ADR mark or above. So let's say SPY over a period of a week traded up 5%. The stock that I'm trading has the potential to trade up to 25% because it's 5 times faster than SPY. So you can sort of see where that compounding or that like fast money comes from. It's just being in the right stocks at the right time because they move faster and you're trying to catch the move up and then get out when they are pulling back or moving sideways. So for moving averages, the moving average, which you'll see are just like the lines on the charts that I provided. The moving average is the average price of a stock over a period of time plotted as a line. So this line can be smoothed a couple different ways. The most common are going to be an SMA or an EMA. So that's a simple moving average and an exponential moving average. They are basically going to be the same thing. The SMA is going to be just very slightly smoother, but they are essentially the exact same thing. And then indicators, there's basically an infinite number of indicators that you can use when you're charting. And one of the big things online is that people are really going to try and convince you that there's some magic indicator that is going to give you all the right signals and you're just going to be able to buy when it tells you to and then sell right when it tells you to get out and you'll just become a billionaire. But it just isn't the case. It just simply isn't. And then the most commonly used are going to be the MACD, which is the moving average convergence divergence indicator, which is a bit of a mouthful, and then the RSI, which is the relative strength index. I personally use the MACD intraday. But I think that that's going to be something that's going to be a little bit more covered in when I go over like my order to my like my order and entry techniques there. But that's really it for what I think is important for this subject. The next video is going to be talking about market breadth and market cycles and like price cycle. So this is sort of where we're starting to get into the nitty gritty of it. This video is a lot of just sort of context for how the fundamentals of the market works, and I think that that's important to sort of outline because not everybody knows that, and it's something that's sort of convoluted and a little bit hard to piece together yourself. I hope that you enjoyed this. I hope it was informative, and I hope that you learned at least something. But yeah, so this is from this point on, we're going to be sort of starting to get into the real nitty gritty and details of everything.